Hello everyone and welcome back to Explain the Charts, your go-to channel for in-depth market analysis. Today is October 28th, 2025, and we are looking at the S&P 500 ETF, ticker SPY, which is making headlines by surging to new all-time highs. First, let's cover the news driving this powerful rally before we dive into the charts. Reports from across the financial world are confirming the bullish sentiment, with the S&P 500 index itself closing above 6,800 for the first time ever. This record-breaking move is being powered by a combination of factors, including very strong earnings from major tech companies like Qualcomm and Nvidia. There's also growing optimism around a potential US-China trade truce and benign inflation data, which has given the market an all-clear signal from the Fed for now. With the Dow Jones also hitting records above 47,000, we're seeing broad market strength. However, some analysts note the market might be taking a breather, suggesting this powerful rally could be due for a pause. Now, let's see how this incredible news is reflected in the price action on our charts. Here on the daily chart, we can see the full picture for 2025, and the primary trend is undeniably bullish. The market has been in a steady uptrend for most of the year, carving out a series of higher highs and higher lows. Notice the powerful move just yesterday, a strong green candle taking us firmly into blue sky territory, which perfectly matches the headlines we just discussed. However, this uptrend has not been without significant volatility. Let's zoom in on the sharp pullback we experienced back in late March and early April. During this period, the market saw a dramatic drop from around the 575 level all the way down to a low of about 481 on April 7th. You can see the massive increase in volume and long candle wicks, indicating intense fear and selling pressure. But what's crucial here is the V-shaped recovery that followed, demonstrating immense dip buying strength. That 480 to 500 zone now stands as a critical long-term support level for the entire market structure. Now, let's go back to the full view of the chart. After that April recovery, the market began a methodical climb, eventually breaking the previous highs in May. More recently, we saw the price peak around 678 in mid-September before entering a corrective phase. This pullback found a solid floor right around the 653 level on October 10th. This 653 mark is now our most important near-term support level. A break below it would signal a significant change in market sentiment. From that low, we've seen an explosive rally over the past 2 weeks, culminating in yesterday's breakout to a new all-time high at 685.24. With no historical price data above us, we are officially in price discovery mode. The next logical targets for bulls will be psychological round numbers, such as 690 and then the major milestone of 700. On the support side, the previous resistance around 678 should now act as the first line of defense on any pullback. Below that, we have the consolidation area around 665, followed by that critical low at 653. Now let's switch to a shorter time frame to analyze the mechanics of this recent breakout. Looking at the hourly chart since the October 10th low, the bullish structure is crystal clear. We see a consistent pattern of higher lows and higher highs, indicating a healthy and sustained uptrend. After building a strong base in the 660s, the price began to accelerate last week. The catalyst of cooler inflation data and strong earnings, as mentioned in the news, provided the fuel to break through the 678 resistance level. You can see that once that level was cleared on October 24th, the buying pressure intensified significantly. This shows that traders were waiting for confirmation before committing new capital. For short-term traders, the trend is clearly up, and buying dips has been the winning strategy. The immediate trend support on this hourly chart sits around the 682 level. To get an even closer look at yesterday's explosive move, let's switch to the 15-minute chart. Here on the 15-minute chart of yesterday's session, you can see the market gapped up on the open and never looked back. The price established an early low around 682 and then proceeded to grind higher for the entire day. This type of steady, low volatility climb on high volume is a sign of institutional buying and strong conviction. It's the very definition of the surge that the news headlines were describing. The price closed near the highs of the day, which is a bullish sign for the continuation of the trend. Now, let's synthesize all this information and discuss what to look for next. We will go back to the daily chart for our final analysis. So, what's the verdict? The bullish case is overwhelming at the moment. We have a strong uptrend across all time frames, positive fundamental news as a tailwind, and a decisive breakout into new highs. From a bullish perspective, the path of least resistance is higher, with initial targets at 690 and 700. Traders looking to go long might see any dip towards the 678 to 680 breakout zone as a buying opportunity. However, we must also consider the bearish perspective. The market is now technically overbought and extended after such a rapid ascent. The taking a breather sentiment is valid, and a period of consolidation or a pullback would be healthy to sustain the long-term trend. A key warning sign for bears would be a failure to hold yesterday's highs, followed by a close back below the 678 breakout level. If that were to happen, it could trigger a quick sell-off to the next support area around 665. The ultimate bearish signal would be a decisive break below the October low of 653, which would invalidate the current bullish structure. So let's recap the key takeaways. Your key resistance levels to watch are the psychological milestones of 690 and 700. Your key support levels are, in descending order, 678, which is the recent breakout point, 665, a prior consolidation area, and the critical line in the sand at 653. In terms of likelihood, I believe there's a high probability, perhaps 70%, that the market continues to grind higher towards 690 as long as we remain above 678. A pullback to test support between 670 and 675 has a moderate 50% probability in the coming weeks as profits are taken. A sharp reversal below 665 has a low probability, maybe 20%, unless we get a significant negative news catalyst, such as a breakdown in trade talks or a major earnings miss. Keep an eye on upcoming earnings reports and any headlines regarding inflation or Fed policy. And finally, please remember that this is not financial advice. This analysis is for educational and informational purposes only, and you should always do your own research before making any investment decisions.